The dollar is tumbling, leaving many investors scratching their heads and wondering why. The dollar peaked in September of 2022 and since then has been on a steady decline, but over the past couple of weeks has just fallen off a cliff and is now trading at a level that it hasn't traded at since April of 2022. Keep in mind, April of 2022 was when the Federal Reserve's balance sheet peaked as well, and April of 22 also marked the peak in the money supply. Now, in markets, nothing ever happens in a vacuum, and so this dollar tumbling is causing asset prices to move in unexpected ways all across the board. We've seen a sharp rally in gold over the month of July, and an even sharper rally in silver. Bitcoin also seems to have caught a bid, as well as the major stock indexes like the S&P 500, the NASDAQ, the Dow, and the Russell 2000, all trading at much higher levels than they've traded in months to over a year. It has also been pushing down on interest rates, everything from the short end of the curve at the 1 year, all the way to the long end of the curve at the 30 year. And to make matters even more confusing, this is all happening at the same time as inflation numbers are coming down past expectations, with the CPI falling to an unexpected 3% year over year, and producer prices only hitting a tiny 0.1% annual rise. So what is going on? Quick announcement, I will be speaking at the Stock Pulse Silver Symposium from September 29th through October 1st. I would love to see you there. There will be plenty of time for us to meet, hang out, get a drink together. There's going to be a ton of other great speakers there. I'm going to be speaking about the history and the future of sound money. Love to see you there. A discount link for the tickets is linked in the description below. In order to understand why the dollar is falling right now, we have to explain the fact that markets are forward looking. So what in the world does this mean? Well, basically investors are always trying to anticipate where the puck will go, not where the puck currently is. For example, Apple is currently trading at a $190 per share. Now, let's say that you are reasonably certain that the price of Apple was going to be $190 1 year from now. Would you buy that stock? No, it wouldn't make any sense, because that tiny little bit of risk that you're wrong about that means that you're taking no potential upside for the risk of being wrong. Might as well just keep your money in cash. But let's say with Apple trading at $190 per share, you were still reasonably certain that Apple was going to be trading at $300 per share 1 year from now. Would you buy Apple at $190 then? Of course you would. That'd be a fantastic trade. 50% roughly in 1 year. Absolutely, sign me up. But the question is, how certain are you about this? Did you see it in a magic crystal ball and you know for 100% certain that it's going to be trading at $300 exactly 365 days from now? If so, you go all in. You borrow as much money as you can, you pile in, you buy call options on it, because you know 100% with certainty that it'll get there. And let's say you also tell your friends and your family about it so they can get rich off of this move as well. They start buying in, but they also have people that they care about that you don't know, and the word starts to spread and everybody realizes, hey, in 1 year, Apple's going to be worth $300 a share. Well, guess what's going to happen? There's going to be so much buying pressure from that certainty that that's what it will be worth in the future, that the price will get bid up higher and higher and higher, and before a year comes, the price of Apple will approach $300. But then something funny happens, because once it hits $299.99, now there's no longer any incentive to buy the stock there. And so that absolute certainty that the future value is $300 brings that future value into the present. But there's a problem here, because nobody has a crystal ball. You can't just look into the future and know with absolute certainty what something is going to be worth. So you're always dealing with expectations about the future value, not certainties. The more certain the market is about a future value, the faster that future value will be brought into the present. And the less certain the aggregate consensus market is about a future value, the less that value will be brought into the present. So now that we understand how and why the market prices those future expectations of value into the present, let's take a look at the dollar again. It is falling off of a cliff. So this is the market market expecting, and when I say the market, this is the aggregate buying and selling and the aggregate potential buying and selling of all market participants coming together to a consensus through an auction process on the current price. So that's what the market is. So with the dollar falling over the last couple of days, what that's telling us is that the market expects that the dollar is going to be worth less in the future than it is today. And the higher the certainty of that, the more that future lower value gets brought into the present, and that value starts to crash right now. So the question is why? Well, first we have to look at how interest rates affect the US dollar. By the way, if you are sick and tired of unexpected moves like this impacting your portfolio negatively, you need to learn some of the advanced investing strategies that I teach to all my members in Heresy Financial University. You get unlimited access to my entire training library of material, and anytime I get my new lessons and new courses created and published, you automatically get access to everything. It's where you get access to long-form deep dives on advanced investing strategies to help you make more, keep more, and give more. Link is in the description below. Over the last couple of years, we've seen interest rates absolutely skyrocket from a rock bottom all-time low of basically 0% to now trading north of 5%. When interest rates are high, that is sending a signal to economic actors. The incentive placed on the individual is to save, because in a fiat system, savers are lenders. That is why in a money market fund or in a savings account, more and more today, you can get paid higher and higher interest rates. Not at the big banks, but many savings accounts today are paying north of 5%. So as an individual, as an investor, as a corporation, you may be looking and saying, hey, if I take my cash and I invest it, I'm taking on risk. If I invested in the S&P 500, maybe I'm hoping to get 8%, but there's always the chance it goes down instead. But if I save my money and lend it out doing a lower risk option, I can get 5%. If I loan it to the US government, who can always use their monopoly on violence to tax people and pay me back, I can get 5% almost risk-free. Then the incentive in the system starts to flip towards saving rather than spending. It also affects debt, because remember, we are a highly leveraged economy in a fiat system. The government, corporations, households have tons of debt. So as interest rates go up, it makes that debt more expensive. If I keep the debt that I have, that means I have to take on new debt to pay off the old debt to just keep the same amount of debt. As I take on new debt to pay off the old debt, I'm slowly increasing the cost of that debt because the new debt has a higher interest rate. So more and more of my income is diverted to just servicing the debt. And then also, if I decide to pay down the debt because I don't like how expensive it's getting, that's even more of my income devoted to just getting rid of the debt now. So we see high interest rates create the incentives in a system for deleveraging and saving. It also disincentivizes taking on risk, investing, hiring people, research and development, doing things that might have the chance of producing more wealth. But ultimately, those are all symptoms wrapped up in the package of dollars being more scarce. This is why the growth rate of the money supply is currently negative. The money supply is shrinking. This is something the money supply hasn't done since the Great Depression. Simply put, there are less dollars in circulation today than there were at the peak in April of 2022. When something becomes more scarce, relatively speaking, it becomes more valuable compared to everything else. So again, it incentivizes savings, getting dollars, disincentivizes spending, getting rid of dollars. So dollars are more scarce. Now don't worry, we're bringing this all full circle, but right now you're probably pretty confused because I'm talking about how the Federal Reserve's actions since April of 2022 have made dollars more valuable and more scarce. But when we look at the chart of the dollar, the value is falling off of a cliff. So what in the world? It looks like it's doing the exact opposite of what you would expect, right? Well, how do markets work? Are they pricing in the current value or are they trying to expect the future value? So during this whole time, when the dollar was rallying versus other currencies, the market was pricing in the future fact that dollars would be much more scarce in the future relative to other currencies, because that's what the dollar index is measuring, the dollar's value versus other currencies. So markets were expecting that in the future, there would be fewer dollars, the dollars would be more valuable than the other other currencies because of the Fed's actions. But the dollar index peaked and has been falling for months now. This is not because in that moment the dollar was becoming less valuable than other currencies. That's because the market was expecting that the Federal Reserve's future actions would make the dollar less valuable compared to other currencies. And that's what it's still doing now. In short, the market is anticipating lower rates in the future. It's no longer pricing in hikes. So the question is, why is the market anticipating lower rates? 3 reasons. Number 1, it's anticipating an end to the Fed hiking interest rates. Number 2, it's anticipating recession. And number 3, it's anticipating deflation. That's right, not disinflation, deflation. So let's take a look at all 3. The President Bullard of St. Louis Fed is stepping down in August. He will no longer be president of the St. Louis Fed. He has recused himself from his monetary policy role on the Federal Reserve's Open Market Committee and has ceased all public speaking. Now, I have no idea why he stepped down. That news is not yet available as of the time of this recording, and I'm not going to speculate on this, but it is interesting that he is one of the most hawkish members of the Fed. In May, he said rates needed to go up by another 0.5 point to curb inflation, and the Fed has only raised rates by 25 basis points since then. He has a fear of replaying the 1970s, with the Federal Reserve characterized as lowering rates too early and reigniting inflation. So he's long been a member who has encouraged higher rates, and he just stepped down. The markets are still pricing in a 92% chance for one more interest rate hike this year, but they're not pricing in anything beyond that, which means the market is anticipating the Federal Reserve is done raising rates. But the Federal Reserve only directly controls the Fed funds rate. That rate exerts influence on the rest of the yield curve, like the 10-year Treasury, but the Fed does not directly control rates like the 10-year Treasury. Yet, interest rates like on the 10-year have still been falling lately. This is due to the market's anticipation for a recession, because even in the free market, you will have lower interest rates during a recession. It's not just from the Fed lowering rates artificially to blunt the pain. So let me explain how and why that would happen. During a recession, prices fall. Asset prices fall, people lose their jobs. Generally, economically, it's a very weak time period with lots of economic pain. Now, preceding a recession and at the onset of a recession, you likely wouldn't have lower rates at the beginning. But eventually the market would start to price in the future effects of the recession with lower rates. Because as people have harder and harder times, companies spend less money, people lose their jobs. Eventually the spending stops, prices drop, and the savings pool builds back up again. As that savings pool gets larger and larger and larger, the amount of money to draw on to spend gets larger. Suddenly you have savers competing to be lenders. So the pendulum starts swinging the other way again. Prices have already fallen, and now you start to have deals pop up that people who do have the savings start to take advantage of and start to buy them. As the savings pool refills and gets large once again, you have those savers, lenders competing for borrowers, driving rates back down yet again. And so lower rates, especially at the longer end of the curve, can absolutely happen in a free market in anticipation of a short-term recession. And the final piece of this that the market is pricing in is deflation. Because when you have inflation, prices are going up. A lender is going to want to be compensated for that loss of purchasing power. So if you have inflation of 5%, maybe you want to lend your money out at a minimum of 6%. Then you have a real return of 1%. But if prices are falling, then just by saving, you have a real return on your cash. Because as prices fall, that same dollar can buy more and more stuff in the future. So you don't need a 6% interest rate. You'd be fine with a 5% interest rate or a 4% interest rate. And especially if you're competing with other lenders, maybe you're even okay with a 1% interest rate to loan your money out because there's a real return past that. Maybe your real return is 2 or 3% because prices are also falling. And so when you have a steeply inverted yield curve, which we can see on this part of the chart where the short-term interest rates are really high, up to 5.5%, yet the long-term interest rates around 10 years plummet to 3.5% to 4%. That is the market anticipating that prices, that is the market anticipating at the very least a good amount of disinflation. But given the fact that we're already at 3% CPI, it looks like it's starting to price in deflation. With inflation of 3% and a 6-month T-bill at 5.5%, the real rate there is 2.5%, the difference between the inflation and the nominal rate. So if you subtract the real rate of 2.5% from the nominal rate of 3.7%, you get an inflation rate of 1.25%. And that's assuming the real rate stays constant throughout that time. In summary, the dollar is falling off a cliff. This is the market looking forward into the future with an expectation of what the future value of the dollar is. The more certain that future dollar, the more certain that future value, the more that value is brought into the present. This is due to the Federal Reserve's fight against inflation by tightening things up, raising interest rates and making the dollar more scarce, and how the expectation by the market is that now that has come to a conclusion. The near-term future result of that, the market is anticipating, could very easily be recession and or deflation. Of course, we will see whether the market is right or wrong about this. It's certainly possible that the dollar has much further down to go. It's also possible that, at least in the short term, the dollar is done falling, but we'll see. As always, thanks so much for watching. Have a great day.